Mortgage rates have already started to fall after the Federal Reserve Bank said that they might start cutting interest rates this September, and this has realtors excited, this has bankers excited, this has home buyers excited, and this even has home sellers excited. What we just got data for is that home prices in America just broke a new record high in May. Now the median home price in America is selling for $426,900. You can compare that to where home prices were 5 years ago. In 2019, the median home price was just $258,000. Now it's clear why mortgage bankers and realtors would be excited by lower mortgage rates, because lower mortgage rates would hopefully for them mean more transactions. More transactions would mean more commission checks. For buyers, lower mortgage rates would hopefully mean that you can get a cheaper mortgage and you can buy a home for a more affordable price. But home sellers are also excited because if lower mortgage rates do happen, then that might mean you have more buyers, more bidding wars, and higher offering prices for the home that you own. So this is where I want you to understand what's happening in the housing market, because there's a lot of different factors at play. And now with the Federal Reserve Bank hinting at cutting interest rates this September, you want to understand how this is going to affect the housing market, whether you own a home, whether you're thinking about buying a home, and even if you're renting a home, because all these things will affect how much money you pay in rent as well. So let me break this down, but first a quick reminder that on August 15th, 1971, the United States dollar was taken off the gold standard, and because of that, this year, on August 14th and 15th, I'm going to be hosting a live investor summit. We're doing it on the 14th and the 15th. This is my biggest wealth building workshop of the year, where I'm going to be going over, number one, how our money has changed over the last 50 years and over the last 5 years, but more importantly, how you can build wealth in this new changing economy with the higher interest rates, with inflation still around, with the economy slowing. How do you identify financial trends and how do you build wealth in this changing economy? So if you'd like to join, all you have to do is register. It's free and it's virtual. I got the link for you to join down in the description below. Just make sure you do it soon because we have a limited number of people that can join me live. So let's take a look at how much more expensive it is to buy a home today versus 5 years ago. The median home price today, $426,900. If you can go out and get a 6.5% mortgage, which I get it, it's a little bit lower than the average 30-year mortgage today, but let's be generous because we're starting to see mortgage rates fall. If you get a 6.5% mortgage, 20% down, your monthly payment today is $2,159 a month on the median home. Fast or backwards, 5 years, when the median home price is $258,000, if you could get a 4.5% mortgage and put 20% down, your payment on the median home then was $1,050. So $1,050 5 years ago, today is $2,159, more than double what it was 5 years ago. So when we talk about affordability of homes, you got to look at a few different things. You got to look at, number one, the cost to buy the home, because that includes the down payment, and number two, the mortgage cost. And we know that home prices are up in many instances 40 to 50% in the last 5 years, but the mortgage cost on that same home is up about double in many instances. So if your salary did not double over the last 5 years, then there's a good chance that you don't have the same ability to afford a median home in America today like you did 5 years ago. That's the first part. And this is what has a lot of people confused about the housing market, because it is expensive. But it's not just expensive to purchase, it's also expensive to rent. And part of the reason why it's expensive to rent is because, well, if investors are buying homes or rental properties or building properties at today's prices, they have to make a return based off of today's prices. Because a developer or a investor is going to want to make a profit. And for them to make a profit, they have to cover their expenses. That means they have to cover their property taxes, their insurance, their maintenance, and management fees, and then their mortgage cost. And so if the cost to acquire rental properties for an investor are higher, they're going to need higher income to justify those higher costs, which is why rental rates have gone up so much over the last few years. And this is where we have a lot of interesting kind of excitement between the mortgage bankers and the realtors, because they've been waiting for and asking for these lower mortgage rates. The Mortgage Bankers Association and the National Association of Realtors sent a letter to the Federal Reserve Bank last year, kind of begging them to start cutting interest rates sooner, because commission rates were falling. And the reason why they were falling is because, number one, people were closing way less deals. And then number two, you had the whole lawsuit going on with the National Association of Realtors. But with less deals being closed, that meant realtors and bankers were just getting less commission checks. And that comes after some of the biggest boom in the housing market that we've ever seen. In 2020, 2021, and into 2022, that was one of the hottest housing markets that America has ever seen because everybody wanted to take advantage of the low mortgage rates. People were moving out of the cities. People started to work from home. And there was a lot of reasons why people started to move. And that meant that commissions were soaring. Not just that, the dollar amount for the commission checks were getting bigger, but the number of commission checks were also getting bigger because realtors and bankers were closing deals left and right because everybody wanted to buy a home, everybody wanted to rent a new home. Today, and over the last 6 to 9 months, that slowed down significantly because many people stopped. They couldn't afford the higher home prices. They couldn't afford the higher mortgage costs, and they didn't want to buy a home. They stopped wanting to compete because they got outbid on so many homes. And so that meant that many realtors and many bankers stopped seeing those number of commission checks. And this is where the Mortgage Bankers Association put out this statement after the Federal Reserve Bank said that they might be cutting interest rates in September. So this is what the Mortgage Bankers Association said, quote, "We expect that mortgage rates will continue to drift lower through the remainder of 2024, particularly if the Fed does launch a series of rate cuts in September." So a lot of excitement, essentially, that they're expecting lower mortgage rates. And of course, that is good for your bankers because that means more refinancing and more mortgages. And these bankers are paid on commission because if you go out and you do a refinance or if you purchase a home and you get a mortgage, they get paid a commission check. Now, the question is what does this mean in terms of the economy? Because we know what this means now on the consumer side. We know how lower mortgage rates affect you. We know how they affect realtors. We know how they affect bankers. But what does this do to the general economy? And this is where you want to understand, why did the Federal Reserve Bank raise interest rates in the first place? They raised interest rates in the first place to fight inflation. Well, why did they have to do that? They had to do that because they created the inflation. When the 2020 pandemic happened, the Federal Reserve Bank cut interest rates to the lowest levels ever, and they started doing quantitative easing. They started printing money. This gave a lot of people access to a lot of money, and everybody started buying homes. As more and more people started buying homes, developers and builders couldn't build homes fast enough. And so you had many bidding wars, where you'd have 20 people bidding to buy one home, sometimes more. And when you have these intense bidding wars, the way you compete is not through an arm wrestling match. The way you compete is by a higher price. And so now you had all these potential home buyers that were bidding higher prices to purchase homes. And so home prices started going through the roof because you'd list your home for sale for $380,000. And then you get offers for $495,000. And you as a seller are not going to say, no, my home is not worth $495,000. Just give me $380,000. That's not what you're going to say. You're going to say, okay, we'll take the highest and best bid. And so that's why home prices can go up a lot faster than they can go down. So home prices shot up very quickly because of that. Then this hot housing market contributed to hot inflation numbers. And then this had the Federal Reserve Bank worried of how inflation would impact consumers, because inflation means that you have less spending power. It means you have to spend more dollars to buy things. And it wasn't just homes that saw inflation, it was everything. Everything you wanted to buy had gone up in price. So this posed a problem. And that problem then had to be fixed through higher interest rates and quantitative tightening. Quantitative tightening is the Federal Reserve Bank pulling money out of the system. And the higher interest rates are, of course, the things that drove up mortgage rates and credit card rates and car loan rates and business loan rates and even federal debt rates. So now we had these higher interest rates working to fight inflation. And now, come September, it looks like, again, we don't know for sure. Things could change between now and then, but the Federal Reserve Bank is now hinting, they're saying in the Federal Reserve Bank meetings that we could be due for an interest rate cut in September. Well, let's play that out. If interest rates get cut, then that would in theory mean mortgage rates can go down. Car loan rates can go down. And if mortgage rates start to go down, what is the hope for that? Well, the hope is then if mortgage rates go down, it becomes a little bit more affordable to buy a home. Well, when things go on sale, what do people generally do? Like when Macy's has a big sale, what do people generally do? They go stand in line and they want to go buy that thing. That's why you see a lot of shopping on Black Friday and Cyber Monday, because things are on sale. So if mortgage rates start to go down, that could have a counteractive effect on inflation. Because if interest rates go down and people start to say, oh, mortgage rates are cheaper, maybe I should go out and consider buying a home again. And all these potential buyers that were sitting on the sidelines suddenly wake up and start looking at homes for sale. That could push more potential buyers into the market. It could create more bidding wars. But it's not just that. It could also then make refinancing a little bit more exciting, a little bit more enticing, because home values just broke a new record high. Which means if you own a home, chances are you have some newfound equity in your home. And for many Americans, unfortunately, who are not financially educated, that means it's free money, which is exactly not what that is. I'm not advocating for this at all. I'm just telling you what is the mindset for many consumers. So when you own a home and the home value goes up, what many people then do is to wait for an opportunity to pull some cash out. And if mortgage rates are lower, then that could create more opportunity for people to do a cash out refinance. Now, that's good for the economy, because that means banks are making money. It means bankers are making money. It means more industries are making money. And that also means that people have more ability to spend, because if you pull cash out, you have more cash in your pocket and more money to spend at Macy's, at Gucci, at Chipotle, at Sweetgreen, which then stimulates the economy. It's great for investors. It's great for the financially educated. It's bad for the financially uneducated, because that means it's easier for people to go into debt. Cheaper debt makes it easier to go into deeper debt. So this is where my goal for you is to be a financially educated investor and understand how our financial system works, because our system benefits the financially educated. And it really screws over the financially uneducated, because the financially uneducated are spending money they don't have on dumb things, and they keep spending money through the help of credit. And if credit gets cheaper, it becomes easier to access more credit. Now, of course, it's going to be a little interesting, because right now we're seeing more and more people get tapped out on debt. Credit card debt just broke a new all-time record high. Household debt in America is at an all-time record high. And we're starting to see more and more Americans ask for discounts. I made a video last week talking about how McDonald's and other fast food chains like Taco Bell, Wendy's, Burger King are implementing or revising their value menus, their $5 value menus. Remember when it used to be a $1 menu? Well, now it's a $5 value menu. But the reason why they're doing this now is because they're realizing that lower income Americans don't have any more money and they can't keep paying the higher prices. And now they're asking for discounts. We haven't seen that since before the pandemic. It's now the second half of 2024, and people are finally starting to say, hey, I can't keep affording these higher expensive things. I need a discount. And this is where we're starting to see some companies start to create these new value plans to reattract these lower income consumers. So yeah, some Americans are really getting tapped out. And this is where, well, the question is, why do you cut interest rates? Historically, the reason why you cut interest rates is to stimulate an economy. Well, where are we right now? If we look at the data that everybody keeps touting, we have 4.1% unemployment. Yeah, it's higher than where we were 12 months ago. But over the last 50 years, that is historically very low. So unemployment is not an issue, according to the data. The economy is still strong, according to the data. Companies are still making profits, according to the data. The stock market is near record highs, according to the data. So what do we need to stimulate? Maybe there's worries about a potential economic slowdown. Maybe there's worries about things that could create bigger issues in the future. But the risk with that is you try to prevent a recession, but you can also make the inflation problem worse. And this is where, everybody can predict, everybody has an opinion. I mean, every single person has an opinion about what should be happening or what's going to happen in the economy, but nobody knows for sure. And my game is not to try to guess what's going to happen, because, well, I'm going to be wrong. I mean, no one can predict what's going to happen in the weather tomorrow. No one knows what's going to happen in the economy tomorrow. But what I can do is work on my financial education. That way I can win no matter what happens. And that's where my goal is, for you to be smarter with your money. That way you can understand what's happening. That way you can make smarter decisions with your money. I mean, I'm just a random guy on YouTube, okay? I'm not a financial advisor. But I want you to understand what's happening. That way you can make smarter decisions with your money. That way you can make more financially educated decisions with your money. And that way you can win no matter what's happening in the economy, whether we have high inflation or low inflation, whether we have a booming economy or slowing economy, whether the markets are booming or the markets are crashing. I want you to be able to win. Because guess what? There's opportunity in each one of these things. And you just got to know how to identify the opportunity, how to identify the trends, and how to be prepared. And that's what financial education is all about. And if you understand this, you can build wealth. If you don't, unfortunately, you're going to be paying the price of making everybody else rich. And that's why I want you to work on your financial education. And this is what I'm going to be covering in my Investor Summit on August 14th and 15th. If you have not registered yet, I got the link for you to join down in the description. And with that, I'll see you tomorrow.